All right, hello, everybody. I am live here with Hark from Framework, and we are about to get started here in just a second. I'm just making sure that we actually have the stream live on LinkedIn here and making sure there's no double back on the audio. Everything's muted. Awesome, cool. So we are live. All right, so let me pull everything back up here on my end. All right, so hi, I'm Gabriel Rucker, and I'm the CEO and co-founder of Founding Titans, a community-focused relationship optimization platform. We're building this to help pre-seed to Series A startups find the right connections and resources for their businesses. And right now, we're actually working on this startup ecosystem webinar series where we're bringing in key players from both early and late stage sections of the startup ecosystem. And so today we have Hark with Framework Venture Partners. So let's go ahead and dive into a little bit more on your background and what Framework is.
For sure, and Gabriel, first off, thank you for inviting me to speak here. It's always great to catch up with you. I guess some context on my background. I'm on the investment team here at Framework, and I've been here for just over 2 years now. And then prior to this, I spent a couple of years in a management consulting as well. You're a Framework. We are a Series A and B VC firm. We're investing out of our third fund, approximately 30 million of AUM, and we lead rounds and potentially co-lead rounds into Series A and B firms, and we are exploring certain seed opportunities too. Our interest areas are mostly SaaS, fintech, and also AI. We are a very data-driven fund, and we really value strong growth, capital efficiency, excellent management teams, and companies operating in good markets. And from our value add standpoint, we are a pretty hands-on firm, and are always here to help and happy to dive into that further. And just, I guess, from an overall standpoint, from geographies, I'm currently based in Toronto, but the firm also has offices in Montreal, Canada, as well as Austin, Texas, too.
Awesome. Yeah, thank you, man. I really appreciate you giving a little bit more context there. Yeah, actually, we met over at the Texas Venture Crawl, which is now
That's
Texas
right.
Venture Fest. And yeah, actually, we're going to have CS on next week as well for everybody in the audience. And so she's going to be talking about some different things. And are you going to be going this year as well? I wanted to ask really quick.
I'm not sure if I'm going this year over one of my colleagues. Maybe if you think about bar crawl down in Austin, there are certainly some colleagues who are interested.
All right. Well, yeah, sounds good, man. And so, yeah, let's go ahead and dive into some questions here. So let's start out with the evolution from being a seed stage company to going to your Series A and Series B rounds. So how do investment strategies and expectations change as companies move from seed funding to their Series A and B rounds?
For sure, it's to say so. At the seed stage, and granted, I've only made probably 2 to 3 direct seed investments in my time, so I can't speak too much about at the stage. However, like what we are looking for as companies move into Series A is building more of that repeatable and scalable sales motion. At the seed stage, we are looking for companies who are building out a strong product. They are starting to get customers, likely around or 500K to about a million of revenue, and they are starting to see traction in the market. At the typically seed funds, they will write slightly more number of checks than a traditional Series A funds. We are a bit more concentrated. Out of our fund, we are looking to write call it about 12 to 15 Series A and B checks. From it, what we're looking for from a strategy from our Series A checks is companies who have started to find fit. They also have paying customers who are exhibiting strong signs of growth with the company, may that be through MRR expansion, including contract expansion, or if we can proxy that data through other metrics such as usage data and general usage on the platform, and start to see inklings of growth. Then at the Series A stage is where we typically help them scale, build out more of that repeatable, scalable team, and think about how can we pour a gas into the fire to really help them acquire newer customers.
Yeah, no, I mean, that makes perfect sense. And I know, it's kind of like the tail end of, early stage for Series A. I mean, some people also consider it just straight late stage, depending on who you talk to in the room, right? Because it's a completely different ballgame, right? You're, really focused on, ramping up scale, just a lot of those growth elements, really in that portion of your business. Whereas, early stage, you're kind of, figuring out product market fit. You're going into a bunch of different test variations, whereas, with Series A, you should really know what you're kind of doing at that point. And now it's really just trying to figure out, okay, how do we multiply this growth? It's not like going from 0 to 1 or 1 to 10. It's really going from like 100 to 1,000, 1,000 to 1,000,000, right? And trying to make sure that you're, and not in terms of metrics, but just in terms of scale, right? Where, everybody kind of has to have that mindset as they're going in to those later stage rounds. Mm-hmm. And so speaking of, mindset and metrics, for the most critical, what are the most critical metrics and KPIs that Framework actually looks at when they're evaluating, Series A and Series B investments?
Sure. So I guess starting with some of the more basic ones, we will typically look at the company's revenue amounts. I'd say typically Series A's are done close to about 1.5 to 2 million of ARR. Obviously, this flexes up and down, and it's tough to really define what a Series A is, but our kind of Series A's are around 1.5 to 2 mil. Looking for strong growth in companies about 100% plus year on year. At the A stage, companies like for us that have to be gross margin positive, as that indicates that the company that has found a way to truly offer this a product in a profitable manner. They will typically be EBITDA negative, and that is quite common at the Series A stage. However, what we're looking for in particular is that capital efficient burn. And in particular, we will look at the burn multiple there. So how much of new ARR have they added in a certain time frame relative to their EBITDA and their cash burn. Diving into customers and unit economics. So unit economics is actually one of our initial gates when we're looking at investing into companies. So we're looking at the traditional metrics such as LTV to CAC being above 3x, and then looking for strong payback periods, obviously depending on the type of business. If it's transactional, looking for that 1 to 2 month payback. If it's more recurring enterprise, call it 8 to 12 month payback, and then we'll start to look into a bit more deeper into companies such as pipeline velocity. What's the size of the pipeline? How fast are opportunities being moved through the pipeline and also added to it? So that's a high level, like some of the initial metrics that we look at the Series A stage.
Awesome. Yeah, no, thank you for that context. And so let's talk next about kind of the challenges with scaling. So, what are the common challenges that companies face when they move into these later stages? And, how can they be addressed for those challenges?
That's a great question. I'd say typically when we see companies going into Series A, most companies have quite a few different avenues that they're starting to explore, and they are being pulled into different directions. So it's often like companies need to be really disciplined about the customers that they are going after, making sure the customers that they are going after are true ICP customers and they can actually learn from them. Say like at the pre-seed and the seed stages, we often see companies who will likely take a non ICP customer if it means just getting cash in the door. However, like moving it into Series A, looking for those ICP customers and being really disciplined. I'd say being pulled into different areas and building out products for specific customers that may not be in their roadmap today is sometimes a challenge that we have seen, especially if they are from large enterprise clients too, as that derails a company's overall product roadmap if it doesn't align. So say like in terms to counter that, is being really disciplined, thinking where does growth come from and what kind of growth is important, and also like what can we learn from the customer base. And then one other thing I'd say, the challenge to scale at the Series A stage, depending on the type of customer that the startup has, is just truly the size of it. It's very different going after different going after 5 clients each with 100K ACVs as opposed to one whale client with a 500K ACV. If a lot of the sales effort goes into that massive enterprise client, it can speed down time to revenue and also increase the feedback cycles to understand more about the actual product. So making sure that at that Series A stage, obviously people are trying to chase after those enterprises, but make sure to really iterate within the mid-market too, just to keep customer velocity going strong. Obviously, it's a case by case depending on the type of business, but so those are some of the scaling problems. And then a third one I'd say is thinking about team, because especially as companies hit Series A, most of the sales to date have likely been founder-led sales and perhaps from prior relationships, especially if they've operated in the industry. However, what we are really looking for now in the Series A is how do we build that repeatable, scalable sales process? Like how many BDRs do we need? How many AEs do we need? Do we need any industry evangelists on the team as well? Thinking about structure, and then how do we transfer some of the knowledge from the founder to the sales team to make sure that they're efficient and that the founder can make sure, and if they're assuming that they're the CEO, can make sure that they're running the overall business and not just selling too.
Yeah, no, I mean, you hit the nail on the head, especially with that team portion. I have a lot of founder friends that are, in that Series A, Series B stage, and really being able to hire the right talent at the right time is one of the most critical challenges that I know a lot of them face, especially with, usually the founding team might not always be the team that, you're going to utilize at scale, right? Like everybody may not be that manager material. So you might have to, bring in some more senior level individuals to actually be able to run some of those teams, especially with a lot of the technology companies, right? Like with engineers, I see that a lot more where, they really great at their jobs, really great at, getting the product to the point of, that Series A stage, but then there's kind of that cliff where now they have to, manage a team of maybe 5-10 people. And really figuring out the challenges that are addressed with that as well. So yeah, definitely +1 to all of that as well. And so, let's talk a little bit about sectors. I know before you were talking about like SaaS and FinTech and AI, are there any specific sectors or industries where you see some more opportunities for late stage investments, particularly at these, Series A and Series B stages, maybe even later on, maybe some companies that you want to highlight, or just, within the industries? And it doesn't have to be with framework either, just in general, what you've kind of seen.
For sure. So this is just based on the deal flow that I've been seeing in recent months. So we're seeing actually quite a few more HR tech deals in the last few months. Lots of supply chain and manufacturing deals. I think there are lots of those supply chain deals raising seeds a couple years back who are now maturing into that A and a B stage. We're seeing lots there. Seeing lots of deals, particularly in a health tech as well. A couple of years back, like when they were trying to get initial traction with the hospitals and whatnot, and now they're actually seeing success. So that's definitely exciting. And then overall, I think lots of DevOps tools and also data companies, essentially companies that are feeding into the transformation that essentially comes from AI. Obviously, everyone's talking about AI. Most of the deals that we see today have some spin of AI to them, whether it's actually true AI or it's just a bit of a big data is a different story. But every company that we see nowadays has some layer of it and is trying to include AI. Say like naturally, like we are a fintech fund, so we have been seeing lots of fintech deals. Say fintech has fallen a bit out of love in the last 2 to 3 years. However, it's definitely we definitely still see great opportunities at the A and a B stage for fintech too.
Nice. Yeah, the HR tech actually doesn't surprise me. I've seen a lot of companies that are, focused on, different levels of SaaS in general. And HR has come up a lot more. Being able to offer these functional products and services, I guess kind of in that, vertical SaaS arena where, it's those models that nobody's really thought of, or it's just not very sexy or anything like that, but it is definitely needed and vital. And a lot of those companies are scaling extremely fast with those current markets right now.
Yeah.
Just because, a lot of them are really underserved. So my advice to everybody is always, if you can find an underserved market, have a painkiller and treat a painkiller instead of just giving them a couple of vitamins and getting them about their day. I always recommend that to companies. And so for, timing out a Series A, and especially as people transition from their A into their B, what indicators does a company really have to look for during those funding rounds? And, what should founders prepare for during those critical stages?
For sure. So I guess like the basic one, which is kind of flex up and down, is revenue. Like I think if you're at a 500K ARR, is definitely early for a Series A, but the way that I kind of see is what kind of characteristics does the company have that make them more of a Series A target. For example, like I've seen businesses that have scaled from 0 to $2 million of ARR in the first 8 months, and I'm like, that's amazing. Technically, the ARR should be a Series A, but a lot of the processes and ops have not been put in place. A lot of the ICP is not there, right? So I see that as more of a seed. Like what I look for when a company is ready for a Series A, I think one, it has paying customers. Customers are giving them feedback. They're starting to know what is working. Why do customers like them? What in the product's working? What exactly can they chase after? And a lot of what we see at the Series A stage, like part of the use of proceeds naturally goes towards product development, but a lot of the round sizes typically also just goes towards hiring out a sales team. So we see companies ready for a Series A once they have sufficient demand, customers like them, they have proof points, they have customers expanding, but the founder or whoever's currently selling the product just doesn't have capacity. And they're a bit overwhelmed by the demand that they can bring in some more BDRs, AEs, and are ready to actually train them properly such that they can go out and then execute. So bringing out more of that playbook. So when we see Series A companies, it's typically that they have something that works. They just need some capital to really go after it now and to chase it. And that's for pretty generic. I'd say for like typical SaaS companies. Obviously, it depends if you're going very very deep tech or into infrastructure AI. More of that Series A funding is going to be towards product and just building and building and building. But for a traditional B2B SaaS, a lot of that surrounds sales.
Yeah, I think one key point that really stuck out to me with that is the ICP portion of it. There's actually a couple of companies we were speaking with on the resources side that we provide for founders, and a lot of them kind of transitioned into honing in on a specific ICP that was generating them the most revenue, and really just kind of diving in with them for what startups, if any, really fit into that category, and like, are they still servicing them? And these are the companies that started out with, providing their offering to startup founders, right? Now they're evaluating, okay, on these enterprise levels, within our first 2 to 3 years, how many of those, startups are actually spending significant amounts of revenue, similar to basically, have they gotten to their Series A? Have they gotten to their Series B, C, whatever else it is? Like, have they progressed and kind of transitioned into more of an enterprise or mid-market level client for us? And really, walking through and having those, really in-depth conversations with those companies. And it's really great to see, some of those individuals and how they were kind of thinking about those processes as they hit, that Series A round, which for every single one that I've spoken with, it's usually around that ICP conversation of, what is that? And for everybody that's in here, the ideal customer profile is what we're talking about there. So, who are you actually targeting and who's actually buying this, right? So definitely, love and +1 to that comment, and really anything else as well.
Yeah, I'd say just one thing to add to that. Like, and like we actually see so some of our like seed investments right now we're actually looking to a seed round in a construction tech company. So it's interesting. So they are intentionally focusing on that smaller slash a mid-market customer profile. So like, we just need to get our product out to as many customers as we can and just get feedback and get feedback. And they're like, once we know what the feedback is, once we've built what they want and we know exactly how to pitch this product, then the ARR will typically correspond with the level such that they can raise a Series A. They know exactly what to do, and then boom, start to move upstream towards the higher mid market and then enterprise segments too. So it's definitely valid to stay with those smaller customers and get faster feedback cycles, but some point, if you're going to go after enterprises, you're going to need resources. Those are longer sales cycles. So having a team working on just the enterprises and then the one with just the mid-markets is definitely valuable.
Yeah, I mean, we're talking to an enterprise client right now for Founding Titans. And basically, initially we spoke with them. They're like, oh, yeah, around 3 months. And, as we continue to have some in-depth conversations as we're moving along, they're like, yeah, no, go ahead and double or triple that timeline, actually. Yeah. And I knew that right off of the bat. I mean, I've been working with startups for over 10 years. Like, every time when you're dealing with enterprise customers, it's the same thing with dealing with developers, in my opinion, right? Like, whatever the timeline is, double it and then double it again. It doesn't matter what they give you, because you're always going to, unless you have like a really in-depth relationship with them and maybe you're a previous employee there and you know exactly how their inner workings actually, are, those timelines are absolutely atrocious, especially if you're actually building something that needs to get fixed. Surprisingly, it takes way longer because you have to get buy-in from the individuals in the organization. And like, there's different levels of those gatekeepers that everybody has to really deal with. And then from those basically one thing that I wanted to also highlight, just kind of feeding off what you said, for those, pre-seed and seed companies, that doesn't really change. It sounds like as you go to seed and as you go to Series A and B, where it's basically just, feedback build, And that's really how every startup should operate. I mean, that's the difference between, an SMB or a mid-market company or enterprise, whatever else it is, versus you being a startup, is that adaptability, right? That's why you see some of these enterprise companies saying we have like this startup mentality, which is BS every time they say it. But it's just like that ability to take feedback and iterate quickly and really just, okay, does this work? Does it not work? And just strict revenue. And those are those two categories, and just continuously going through those processes and motions. And your team is small enough to where if you need to pivot or make a change, you don't have to go up some huge line of command. You just have to be able to sit everybody down on a webinar or a meeting or, whatever it is, and just say, hey, let's brainstorm really fast, and we have all this data, let's sift through it, and then let's just get it done. Right. And then just build out those processes and plans versus, a major enterprise where, you're sitting down for weeks at a time and having these, long-winded meetings just about the most minute details of things. And so that ability to, pick up quickly, I'm glad to know that still kind of keeps in line as companies start to grow as well.
Sure.
And so so let's talk about valuation. We talked a little bit about it here, but how do you approach the challenge of valuing these companies at these later stages, especially with the current market right now?
For sure, yeah, that's an excellent question. And valuation, I think it's commonly known. It's more of an art than it is just like cold hard math. So let's take it at a high level. There are a couple of different approaches that we use. One, we will look at the comparable companies that are public, and then two, we will also look at the precedent transaction. So we'll look at similar companies in the space, ideally at a similar stage, and also ideally at a similar timeline, just some more recent transactions to understand what valuations they have raised at. Or there are some caveats to this, and like I also said, ideally a couple times in there, and that was intentional.
Yeah.
It's really hard to get all of the information there. If you know a competitor's valuation, you may not know what their revenue's at, so it's tough to know where the valuation's at. So how we kind of go about this is typically a blend of the comps plus assigning a premium based on, it could be gross margin, or it's more commonly a premium based on growth, and then blend that in with the precedent transactions. And from an ARR standpoint, it's like, we will look at the ARR of what is alive today. However, if there is a significant deal that could potentially increase your ARR by 50%, that should be closing in the next 4 months, we would then diligence that deal to try to understand if we can give some ARR credit towards that company. So thinking about pipeline is extremely important. So, like, for example, one of the deals that we did earlier this year, they're at about 2 million of ARR when we first looked at the deal and then signed a term sheet, and the multiple was definitely frothy, and internally we were like, oh boy, this is a big multiple. However, when it actually came time to closing the deal, ARR actually increased about 4.2 to 4.5. So we looked at the pipeline. It was like, it's super frothy based on the current ARR. However, look at the pipeline. Think about how fast can they grow into the valuation. Then we'll look into what's fair. So if we were looking into a company today, we'd say if they're at 1 million of ARR, I would then think, how fast can they get into 2? How fast can they get into 3? And when we do that through very thorough pipeline analysis, think about what's fair too, because we also have to take into consideration what's a valuation that is attractive enough for other investors to come into the syndicate in this round. Because if you price it in too high, it's going to be tough to attract syndicate, tough to fill up the round. And then evaluation of this round is taken into consideration by the subsequent rounds as well. So we want to make sure that the company is priced fairly. It's like one snippet that I've seen some companies do. Like if they have super big deals coming up, they'll typically try to bridge until those deals are closed, because in their mind they're like, hey, like this should definitely count towards my ARR. This is going to close. However, from an investor standpoint, I'm like, I don't know that for sure, right? Like I haven't been in this conversation, so it's an art to figure out where the company lies.
Yeah, no, I mean, that makes perfect sense. I mean, even, utilizing like LOIs, MOUs, like I've even had conversations with people during the later stages that actually didn't know the major differences between those two. It's both early and late stage founders that I've during my consulting time kind of educated on, like, hey, one of these is binding, one of these is not binding, one of these has like different advantages versus disadvantages, as well as why are you doing an LOI when you can just sign a contract right now too, is what I've talked to a lot of founders about. Like if you can show the traction early and show that these are signed paying individuals, like if you can get the money, if you can go ahead and get something on paper, but make sure you're also getting the right things on paper and showing the right levels of traction. And it's not, at the end of the day, just to show like the VCs what they want to see or what they want to hear. Like it's your business, right? It's your company, and these are the things that you need to have to protect the entity that you're actually working to build. Mm-hmm. And I always like to hammer in a lot of those points as I continuously go through and speak with a lot of different founders, really at just every stage, because just because they're in the later stage doesn't mean that there aren't mistakes to be made, but It's also utilizing the resources that a lot of the people that have invested in them, and really also keeping that open form of communication with them as well.
Yeah. A couple things I would add to that too. I'd say one, like it's super important for founders to think about how much dilution you're taking at each rounds. And that typically actually gets a bit muddied if you have quite a few different safes converting at different caps. So it's important to really take that into consideration. So like at the A stage, the vast majority of deals are going to be priced out, with the ones that we do. C stage, we see a bit more safes and converts capped out there. So definitely take that into consideration. And then a last point in terms of valuation, it's like, and we've seen this a couple of times, in which case I think like the median, I think seed valuation for pre-money nowadays is about 13.8 million. I think Carta just published that a couple weeks ago, and at the A, I think it's close to double that. And then companies like, hey, well, like if the median seed is at 13.8. why aren't I getting 13.8? Like, why am I being offered 10? Or actually, I believe I should get 20, right? And they're like, yes, that's the median, but there are a lot of different factors. If you have, is it live ARR versus pilot ARR? Is a significant, very, very high customer concentration, customer from just signed on, like all those factors play into it. So it's an art there.
Yeah. And just for everybody in the audience as well, Carta is a really great resource for this. There are actually a lot of other resources that are out there as well for actually modeling out kind of what those safes look like when they convert. Because like, if you're not doing that, you can end up shooting yourself in the foot fairly quickly. I mean, obviously when people are investing in your round, they'll make sure that they give you that advice kind of in that first meeting, but don't mess up your, first or second meeting by just having some ridiculous valuation or val cap or, any of that stuff, because it can really sour a conversation very quickly and show like a place of weakness as opposed to a place of strength, and you're actually going into some of those conversations as well.
Yeah.
So always want to make sure that, a highlight on that as well. And we are partnered with Carta as well. So if anybody needs any of those links for getting set up, if you're not already using them, definitely reach out. And there are also a lot of other tools and systems for really modeling out what those safes look like as they convert as well. But it's something, and that's why one of the reasons why people don't really love safes and why people choose to prefer convertible notes. Obviously, convertible notes are more investor friendly. Safes are more founder friendly. But if you don't utilize safes correctly, it can be less friendly for everybody. So want to make sure we get that out there as well. And so, the post-investment support that you guys get, I want to really highlight on that. So what kind of post-investment support does Framework offer to its portfolio companies, especially as they scale?
Yeah, that's a great question, and it's funny when we talk to most VCs, they'll say, "Oh, we actually offer lots of support," and so for us, the way that comes through is like, so one, if we're doing a Series A or a Series B, we will typically lead the round. We will take a board of director seat and oftentimes a board observer seat. We aren't a fund in which we will show up to a board meeting once a quarter and pray that the numbers are going up and then give a founder flack if it's not, right? We are pretty interactive. So we have other than the typical partner on file, we also have an in-house CTO and an expert at all things technology who helps our companies rationalize tech, architecture, and also product. We also have in-house support as well as external support for a go-to-market too. We also help our companies from a people and talent standpoints as part of our diligence. We actually benchmark. We actually conducted a compensation benchmarking exercise for each of the employees at the company, so understand are they being fairly compensated, and if not, should the compensation be raised. We just want to make sure that employees are well motivated. Typically, so during our investment process, it's a pretty detailed diligence process. Like we see it as more of a growth equity style diligence at the Series A stage. So we like to go in as deep as we can, and then from there we will share our entire investment memo with the CEO and the management team, and we'll walk them through it. And we'll say, this is what we saw. This is the risk that we saw. These are the opportunities. Do you agree? Why or why not? And then we will work with them to come up with a 30, 60, 90-day plan and come up with a plan for the next year or two to really help them execute on that. And then just ongoing support wherever they need. We definitely aren't going to be prescriptive, but when people are needed, we are there, and that's something that's actually pretty cool. We also offer our CEOs executive coaching too. It's a pretty all-encompassing portfolio support approach. It's not really just a partner framework who's going to be working with you. It's lead partner plus our other partners plus the investment team who worked on the file, keeping up with you closely with support from externals too.
Yeah, no, I mean, that's fantastic, especially the executive coaching portion, because it kind of ties back into the earlier part of the conversation where, the team may not be the right team for the later stages. And so being able to have them get ready for those, later rounds if needed, and just being able to provide that additional support, because also with a lot of people that I speak with, as they sort of progress, those early accelerators that they went through, or, the individuals that kind of invested with them in those earlier stages of the company, their services may not be as impactful as the company kind of grows. And so being able to partner with the right people at the different sections of the company, for those different stages of growth and really scale is extremely vital, because if you're not actually getting any of that support, or it's just them throwing a check at you. There's a lot of hurdles that are going to be a little bit more challenging because they don't have that additional support that maybe their competitors have received, or other individuals in the same space, because they were able to work for that strategic capital as instead of just a blank check that's kind of just thrown at them. And so that's amazing that you guys actually provide that support continuously.
And I'd say like two tangible ways in which we try to support. Like one, like simple advice on a business, like it could be very, very valuable case by case basis for sure. Sometimes, like oftentimes, the founder lives it. They already know it. So for us, like one, we are trying to build out our talent network so that we can help refer talent. But two, quite frankly, it's just relationships. Whereas like one of our partners, he's super, super connected with lots of banks throughout North America and the rest of the world. So if we have a company that's a fintech company or trying to partner with a bank, we're like, we know just the guy who can get you a meeting today. And just direct customer relationships is super, super valuable. Two other things, I guess. One is that, and you can see like by the number of portfolio companies that a VC has in their fund, if they have 50 portcos and just 2 partners, and then that's it, it's really hard for them to give each portfolio time, each portfolio company time. So you can try to understand like how much time do they spend. And if VCs have a very concentrated portfolio, they will, by nature, they have more chips on the table for your startup. And then one thing to mention is that we actually try to add value to companies who aren't just in our portfolio too. So we are building out an investor network where if we've talked to a company, or it's just a bit early for us, or if it's not the right fit, we will try our best to introduce them to other companies, to other VCs, and often competitor VCs, to see if they're a fit. So we actually match about 600 plus startups a month, and that's growing every month. So like the whole thing as an ecosystem is that if we can invest in you, we at least want to help you. Right, so then we can see the entire ecosystem flourish too.
Yeah, no, that's fantastic. We're definitely have to talk offline about the matching system, because that's a lot of the stuff that we're working on too. So yeah, it's awesome that you guys did. I honestly didn't even know that was a part of the business. I mean, after all the times that we've talked, but that's that additional support for founders is extremely vital. I mean, that's why I ended up starting Founding Titans, and why we're doing everything that we're trying to do. Like those matches to the right VCs are invaluable, honestly. I mean, you saw it during South by and some of the other points, even during the venture crawl. Like I'll just do that in person for a lot of people, and also for everybody. Somebody's giving you recommendations. Make sure that they're not getting paid for those unless they're they have a broker-dealer license or any of that stuff as well. That's one thing. Like I don't get paid for any referrals that I get for everybody. I do it out of the goodness of my heart and fuel for innovation, right? But make sure that these funds and everybody else, like, because there are a lot of people out there that just kind of make founders pay for investor intros and all this other stuff. But as you see, if you're partnering or speaking with the right people, they'll do that just because it makes sense at the right time to introduce you to the right folks if they want to see you win. So I want to make sure that I highlight that for everybody here as well. And so let's talk exit strategies, because these companies are starting to, operate at these later stages. So how do late stage investments tie into potential exit strategies, and what should founders consider when planning their exit?
Sure.
If they should be even planning it anyways too. That's an excellent question. So when we invest in companies, particularly at the Series A stage, we're like, okay, how do we build this into a $100 million ARR company minimum, right? And that's obviously the goal. We've all heard of the power law. Like VC is
truly follows that. So we're trying to build them into a $100 million business, and we try to come up with a pathway to get there. And we'll typically look at, depending on the company, we will look at the exits of competitors and typically more later stages too, and see, are they exiting via IPO versus some industries will typically exit via they'll be acquired by a financial versus acquired by a strategic. For example, lots of fintechs they are typically acquired by strategics. So as we are building our investment thesis and developing the company, we always have that in mind, thinking about what's the most realistic exit path. Like something to note, I think during exit is what is really realistic in certain paths, and sometimes for a business it actually may not be in their best interest given their likely cap and where they are going to hit from an ARR and exit standpoint. It may not actually be in their right interest to raise VC money. Like I've actually talked to a couple of companies and I'm like, you guys are almost profitable or you are profitable and actually growing pretty well. Like, do you really want to raise VC dollars? And the economics for a founder in some cases may just be that they and their employees and their early investors may actually make more money as they retain more of the ownership just by a kind of not raising future rounds. So we definitely think about that, and then like for every company we will kind of chart a path and think about where can it hit. And oftentimes I've built lots of models, and I'm pretty sure every company in our portfolio per my model should be a unicorn. And obviously, it's just not going to happen, right? Like I've built billion-dollar businesses on Excel. However, reality turns out to be different most of the time. So it's something to think about. And then really think about who it is you would likely sell to. Like, to give a very, very tangible example, if it's an HR tech company who is partnering with one of the payroll systems, if they're very ingrained with ADP, they should definitely think about, should we let ADP in as an investor if we know that at some point they would just want to buy us once we hit 20 to 30 million. Because if you let them in as an investor now, they have a lot of information about you. They may try to cram you down the valuation, and you give them too much power, right? So if you really think about that kind of exit, or say, hey, if we don't want to give ADP just for example, too much power, we should also look into expanding to businesses who use UKG, Kronos, and other payroll systems too. That's just an example when it comes to HR tech. But thinking about strategics is super important when it comes to exit strategy, and also into accepting investment from strategics too.
Yeah, no, that's great advice for everybody. We're especially the points about essentially like just evaluating, the companies that are actually going to invest in you versus might acquire you, because I've actually seen that very often, and like companies that I've seen, probably about like $50 million to $100 million for the offers that they get, and it can also tank certain deals, because I've also heard some of those as well. And so, being able to kind of evaluate that, and being strategic with who you're actually letting in to those rounds, just kind of ties back into some of the information we already spoke about. And also for everybody in the chat, or for everybody that's watching as well, if you have any questions, make sure you put it in. We will ask one more question here, transition over to if anybody has any audience questions. And then if not, then we'll kind of, I'll ask one more final question there. We'll wrap everything up. but I want to make sure that we give everybody a chance, just in case they have a specific burning question for Harkirat. And so, yeah, let me see, because I also want to make sure that, because we are running out of time here, and I've got a lot of questions left that we can get to. I'm glad that we were a lot more detailed in the responses here as well. Yeah, so let's talk about due diligence really quickly. So, how do you interact with founders during the due diligence process, and what qualities do you look for in a founder during that process?
That's an excellent question. Obviously, founders super important to us during due diligence. So in terms of from a process standpoint, how do we interact? One, take an initial call. Ideally, we've talked to the founder a couple of times. We've been tracking them for a couple of years, and we start to know how they think and the vision of the business, so we can just understand the business more. If not, if it's just a cold first time, that we've ever talked to them, try to understand more about the company. Then we'll ask for a data room, get more of the partners involved, and then it's typically lots of back and forth when it comes to the diligence requests as we go into investment committee, and then potentially issuing a term sheet. What we're really looking for. One, obviously, the founder has to know their stuff, right? They have to know the space. Looking for someone who's confident, very knowledgeable, very thoughtful as well. Very, I'd say, pragmatic and also realistic. Someone who's really thought through all elements of the business. We are looking for someone who's truly an expert in the space. And then also in terms of how the founder interacts with us as a firm, I think oftentimes if a founder takes a week to respond to us after each email, then we'll say, I'm not sure if the founder is that engaged with us. They probably don't want to work with us. Do we want to work with them? However, if founder is super responsive and is on top of the ball, that typically goes a long way as well. And then as we go into diligence and we tie into different parts of the business, whether it's go to market or go through the entire financial model or into people and the hiring plan and partnerships, we are trying to assess how thoughtful have they been with each of those steps, and to understand, have they been careful in the decisions, or are they just being pulled in different ways and they don't know how to manage that? We also try to identify what are the founders' strengths and also weaknesses. For example, some founders may be excellent when it comes to operating and product, but they may lack a bit on the sales side, and that's okay. But what we're looking for is then who on the team is going to help them with sales, and who on the team is going to complement them. And if there's no one today, can we hire someone who is going to complement them? So we're thinking about what their strengths and weaknesses are, and also how they complement the rest of the team, and do they have the necessary support functions, and if not, how do we bring that in? But the most important thing is really, do we trust them and do we want to work with them, right? If they want to work with us and they're trustworthy, honest, thoughtful, very smart, driven, capable, this is someone who we want to work with.
No, awesome. Yeah, thank you for answering that. And I don't see any specific questions in the chat, and we're coming close on time here, so probably better to wrap everything up. But I really like to thank you, man, for coming on. I'm glad that you were able to talk a little bit more about framework and the different processes for insights into Series A and B. Yeah, I really appreciate you for your time today, man. Definitely, let's grab some time after this and definitely talk and catch up a little bit more. I know we talked a little bit before everything started, but I want to set aside maybe 30 minutes after this. And so how can people connect with you after today's session?
Yeah, awesome, and thank you so much for having me on here. For everyone who was listening, really appreciate it. Feel free to connect with me directly on a LinkedIn. My name is Harkirat Ahluwalia, or if not, feel free to email me directly. My email is hark @framework.vc. So feel free to reach out re- regardless of the stage or the industry. Always happy to meet new people.
Yeah, and I just posted your email in the chat as well as your LinkedIn. So we
Perfect.
got all of those areas covered. And let me go back here. Sorry, I think my internet hates me for having the LinkedIn stream up while also having this up too. But yeah, make sure I posted your information in there. I'm also going to be posting the information for connecting with myself and for founding Titans as well for everybody that's interested in joining our wait list. We're going to be launching everything hopefully pretty soon here for founding Titans. And also would love to connect with anybody. If you are watching this and would love to actually be a guest, definitely send me a separate DM as well, or feel free to email me, Gabriel@foundingtitans.com, so that we can connect and we can try to get you on for one of these episodes potentially. We're really looking for key ecosystem players, so startup communities, angel groups, VCs, really just anybody that's playing a pivotal part within the ecosystem. Right now, we're not actually doing anything specifically for founders, but we do have something that will be coming up fairly soon here to kind of talk about some founders and their stories as well, and helping them with getting some fund with getting funded. So as soon as we get all those things up, I'll definitely make sure to post that so everybody can submit their information for that for founders. And next week's schedule, we actually have Micah Musa Perlin with Microsoft, and we're going to be talking about mergers and acquisitions. And then right after that, on Thursday, like we said earlier, we're going to be speaking with CS Freeland, who is one of the founders for the Texas Venture Alliance out here in Austin. She and her team put on the Texas Venture Alliance newsletters, as well as the Texas Venture Fest that's coming up in October, and the Texas Venture Gala that happens, and a few other things that we're going to be highlighting during the conversation with her on next Thursday. And for all of our future events, you can go ahead and check those out on Luma. We're starting to post a lot more of those. We do have events all the way out into October. There are a couple of gaps in the schedule as we move people around. So definitely, if you'd like to come up and speak, and have a bunch of questions thrown at you, and really get people to learn more about what you're doing and learn more about different aspects of the startup ecosystem, reach out. And thank you again, Hart, for being on. I really appreciate you, man. Is there anything else you'd like to say or throw in?
Nothing else really from my standpoint. Or just a quick plug, I guess. Like we at Framework are trying to build out an entire startup scorecard in which startups can actually benchmark their performance to their peer sets. So definitely check it out. It's something that we are very data forward and are trying to build out, so we can help someone that way. Please do get in touch. But other than that, not much else from my end. Gabriel, thank you so much for inviting me to speak here today. It was great to catch up, and we'll definitely catch up hopefully in person soon too.
Yeah, no, sounds great, man. And yeah, thank you for that plug. We'll also have to talk about that scorecard thing as well. If you have any links to that, we're going to be sending out. We're sending out newsletters to our current wait
Cool.
list. The wait list is actually at over like 7,000 with the communities we have, as well as the other individuals that have independently signed up. So yeah, definitely shoot that over, and we'd be happy to highlight some of those things. Really, anything else you or Framework wants to highlight, happy to shoot that out to everybody inside of our network. And yeah, thank you all. This session will also be recorded as well. So if there's anything you missed, definitely just after we end this, go back into the link and you'll be able to see everything from start to finish for our time over here with Hark and Framework. So thank you, and have a nice rest of your day, everybody. See ya.